You know, we hear about the stock market all the time, right? But there's this other market out there, one that's way, way bigger, runs 24/7, and quietly affects everything from the price of your morning coffee to what your next vacation costs. I'm talking about the foreign exchange market, or as most people call it, Forex. So today, we're going to pull back the curtain on this massive and often invisible financial world.
So here's the plan. First, we'll get our heads around its just mind-boggling scale. Then, we'll look at how it's kind of this market without walls. After that, we'll break down the three main ways currencies get traded, check out some key tools of the trade, and then, most importantly, connect it all back to what it actually means for your wallet.
All right, let's just jump right in with the big one, the sheer, almost unbelievable size of this thing.
Yep, you're seeing that right. $6.6 trillion. That's how much is traded on the Forex market every single day. It is by far the largest financial market in the world. I mean, to put that into perspective, the entire annual economic output of a country like Japan is less than what gets traded on Forex in just one day. It's huge.
A number like that is so big, it's almost meaningless, right? So what is all this money? What are people actually buying and selling? And why?
Well, at its heart, the idea is really simple. Let's say a company in the US wants to buy some car parts from a manufacturer in Germany. They can't pay in US dollars. The German company needs euros. The Forex market is just a global system that lets the American company swap its dollars for those euros. It's basically the essential plumbing that allows international business to even happen.
Now, what's really interesting is how this market works. Because unlike the New York Stock Exchange, there's no big building, no trading floor with people shouting. You can't just go visit it.
The Forex market is totally decentralized. It's just a massive electronic network of banks, brokers, and dealers all over the world. And because of that, it literally never sleeps. It kind of follows the sun around the globe, kicking off in Tokyo, moving to London, then to New York, and back again. It's a continuous 24-hour cycle, and it's mostly dominated by just four major currencies.
So who's doing all this trading? Well, you've got the big banks moving hundreds of millions at a time. You've got businesses, like our car parts example, and even governments managing their currency reserves. But believe it or not, if you add all of them together, they're still dwarfed by one other group.
Yeah, a staggering 90% of that $6.6 trillion changing hands every day has absolutely nothing to do with buying actual things. It's pure speculation. It's traders betting on which way a currency's price is going to move, trying to make a profit off of tiny little fluctuations that might only last for a few minutes or even seconds.
Okay, so how does all this trading actually happen? It really boils down to three main ways of doing business: spot, forward, and swap transactions.
First up is the spot transaction. This is the most basic one. You agree to buy or sell a currency right now at whatever the current market price is. The price gets locked in on the spot, though the money itself usually takes a couple of days to officially change hands. It's simple, but it means you're totally exposed to any sudden price changes.
Then you've got a forward transaction. Okay, let's go back to our US company buying parts from Germany. Maybe they know they need to pay their German supplier in 6 months. Well, they can use a forward contract to lock in an exchange rate today for a payment they'll make in the future. It's all about something called hedging, protecting their business from the risk of the euro suddenly getting way more expensive.
So you can see the big difference here really comes down to risk and timing. Spot trading is for right now, and you're kind of rolling the dice with the market. Forward trading is for the future, and its whole reason for existing is to get rid of that uncertainty.
And the third major type is a currency swap. The easiest way to think of this is like a temporary trade. A US firm might need Swiss francs for a 3-month project. They can swap their dollars for francs today, and here's the key part: at this same exact time, agree on the rate they'll use to swap them back in 3 months. It's basically a way to borrow and lend in different currencies at the same time.
So which of these do people use the most? Well, as you can see, swaps are king. They make up more than half of all transactions. They're a really important tool for big companies and banks to manage their cash. After that, you've got the spot transactions. That's the daily turn of business and all that speculation we talked about.
Now, besides those three main transactions, there are some more sophisticated tools out there, mostly used to manage risk or for more complicated speculation.
So, we already mentioned forward contracts, right? Those are private, custom deals between two parties. But there are also futures contracts. And the main difference is that futures are standardized. They come in specific amounts for specific dates, and they're traded on a public exchange. That standardization makes it possible for smaller companies and even individuals to get in on the action.
And then we have options. And these These are a different beast entirely. See, with a forward or a futures contract, you are locked in. You have to make the trade. An option gives you the right, but not the obligation to buy or sell. It's kind of like putting a deposit on a house. You lock in the price, but if you decide later you don't want it, you can just walk away. It's a really powerful way to manage risk, because you only use it if the market moves your way.
Okay, so we've got this giant, complex, 24-hour market. But why should you care? How do all these trillions of dollars zipping around the planet actually affect your life?
Well, how is the value of a currency even decided? Ultimately, it's just like the price of anything else, plain old supply and demand. If a hot new phone comes out and everybody wants one, that's high demand. But there aren't many available, that's low supply, the price goes through the roof. It's the exact same idea with currencies. If investors all over the world decide they want to buy US dollars, the price of the dollar goes up.
And we call this change in price either appreciation or depreciation. If the dollar appreciates, it gets stronger. That just means your $1 can now buy you more euros or more yen. If it depreciates, it gets weaker, and your dollar doesn't stretch quite as far when you're abroad.
And this has very real consequences for all of us. When the dollar is strong, that's great if you're a US consumer. Stuff we import from other countries gets cheaper, and that trip to Paris you've been dreaming of is suddenly more affordable. But it makes it tougher for a US company to sell its products overseas. On the flip side, when the dollar is weak, foreign travel gets more expensive for us, but our exporters have an easier time, and you'll probably see a lot more tourists visiting here.
Which brings us to one last really big question. The Forex market is, without a doubt, essential. It's the foundation of all global trade. But when 90% of all that money is just people betting on which way the price will move next, you kind of have to ask yourself, is this a vital market that powers our global economy, or is it just the world's biggest casino? It's something to think about.